The Chinese are at least 5 to 10 years ahead. There's no question about that. Toyota's even formed a joint venture with China's leading EV maker, BYD. Look for more of that from the Chinese automakers. But
views, prospects, and challenges. We've all seen how NIO has been making waves in the electric vehicle market lately, but analysts can't seem to agree on where the company's headed next. Some are shouting, buy, while others are saying, hold up, let's see how this plays out. Today, we'll dive into the data, explore the contrasting views, and figure out what's really going on with NIO. So, is it time to invest or hold off for now? Well, let's first look at what NIO has been up to lately. The company has been hitting some serious production milestones with record-breaking numbers in recent quarters. In addition to that, they're expanding into sub-brands, which could open up new markets and boost sales even further. Now, here's where it gets interesting. Analysts are feeling pretty bullish about NIO's future production ramps and market entry. They see it as a positive sign that the company is growing and evolving in the right direction. This could have a big impact on investor sentiment, with many seeing NIO as a solid investment opportunity. But hold on a sec, not everyone is convinced. Some analysts argue that these production milestones might not be as significant as they seem. They're questioning whether NIO can sustain this level of growth in the long run, especially with increasing competition in the EV market. Now, looking at NIO's financial performance and margins, it's a mixed bag. On one hand, the company has been facing some challenges, with quarterly losses totaling 4.6 billion yuan in the third quarter. This was down from the previous quarter, but still higher than the same period last year. Additionally, NIO's gross margin dropped to 8% in the third quarter, down from 13.3% the year before. But there's hope on the horizon. NIO CEO, William Li, has emphasized the company's focus on efficiency and cost-cutting measures. These efforts seem to be making a difference, with NIO anticipating a rise in vehicle margin to 15% in the fourth quarter. They're also targeting a vehicle margin of between 15% and 18% in 2024. However, there are still challenges ahead. The Chinese EV market is fiercely competitive, with pressure from both startups like XPeng and Li Auto, as well as industry giants like Tesla and BYD. Plus, Chinese consumers are cautious about spending, which could impact NIO's strategy to target the premium segment of the local EV market. But are you missing out on NIO's investment potential amidst all these market fluctuations? Despite its impressive sales growth and innovative initiatives like specialized chips and battery swap services, NIO is grappling with significant losses on every vehicle it produces. Trade restrictions have led to price cuts, job cuts, and a cautious approach to entering the U.S. market. Looking at the numbers, NIO delivered a whopping 55,432 vehicles in the third quarter, with a revenue surge of 47% year over year, reaching $2.6 billion. However, adjusted losses widened to $664 million. The company's reliance on Chinese government subsidies, totaling $2.6 billion, highlights the challenges it faces in achieving profitability. Yet, there's hope on the horizon. NIO recently secured a substantial cash infusion of $2.2 billion from CYVN Holdings, bolstering its financial position. This investment, coupled with support from Abu Dhabi, suggests that NIO may weather the storm despite the competitive landscape in the Chinese EV market. Moreover, NIO's battery swap business presents a potential growth opportunity. The company aims to address concerns about long charge times for EVs by offering battery-as-a-service subscriptions. In addition, several recent market indicators shed light on the sentiment surrounding NIO stock. Despite the broader downtrend in the electric vehicle sector, Baillie Gifford, a prominent investment management firm, notably increased its stake in NIO, signaling confidence in its future prospects. However, NIO's stock performance has been lackluster, mirroring the downturn seen across the EV industry. Over the past 52 weeks, NIO shares have plummeted by over 52%, with recent declines of 4.83% in the last week and 32.19% year-to-date. Nevertheless, amidst these challenges, analysts remain bullish on NIO's outlook. Despite the slowdown in the EV market and aggressive pricing strategies by competitors like Lucid and Tesla, Wall Street analysts overwhelmingly view NIO as a promising investment opportunity. According to TipRanks, 60% of analysts rate NIO as a buy, with an average price target projecting a substantial upside potential of over 90% within the next 12 months. This optimistic outlook reflects analysts' confidence in NIO's ability to navigate industry headwinds and capitalize on future growth opportunities. Furthermore, recent movements in NIO's stock price, including a 1.6% increase on February 1st, suggest a potential shift in sentiment towards the company. Analysts interpret this uptick as an emerging trend, indicating that NIO's current valuation may not accurately reflect its long-term growth prospects. With price targets forecasting significant upside potential, investors are closely monitoring developments in the EV market and NIO's execution of its strategic initiatives. But before we move on, we just want to thank you for watching this far. Now, let's compare NIO's performance with broader industry trends. While the electric vehicle sector has experienced significant growth in recent years, NIO's trajectory has been somewhat turbulent. Despite delivering impressive year-over-year vehicle sales growth, the company has struggled to achieve profitability, facing high production costs and intense competition. Assessing NIO's position within the EV market relative to competitors reveals a mixed picture. On one hand, NIO has carved out a niche as a premium EV brand, attracting customers with innovative features like battery swapping technology. However, the company faces fierce competition from domestic rivals like XPeng and Li Auto and global giants like Tesla. This competitive landscape pressures NIO to differentiate itself and maintain market share. Exploring the factors driving industry dynamics sheds light on the challenges and opportunities facing NIO. Technological advancements, such as improvements in battery technology and autonomous driving capabilities, drive innovation in the EV market. Additionally, regulatory changes, both domestically in China and internationally, impact the operating environment for EV manufacturers, influencing factors like subsidies and emission standards. What about NIO's financial position? NIO's cash reserves and debt levels are critical indicators of its financial health. As of the latest financial reports, NIO has a substantial cash reserve bolstered by recent strategic equity investments. However, the company also carries a significant amount of debt, which raises liquidity concerns. Analyzing NIO's liquidity concerns reveals potential challenges in meeting short-term obligations. While the company's cash reserves provide a buffer, ongoing operational expenses and debt repayments may strain liquidity. To address these concerns, NIO may need to explore additional financing options or implement cost-saving measures. Discussing recent strategic equity investments sheds light on NIO's efforts to strengthen its financial position and unlock shareholder value. These investments, such as the recent cash infusion from CYVN Holdings, provide NIO with additional capital to fund growth initiatives and repay debt obligations. However, they also raise questions about potential dilution for existing shareholders. Meanwhile, geopolitical risks are looming over NIO's expansion plans. The company's ambitions to enter new markets, particularly the United States and Europe, face numerous challenges. In Europe, NIO aims to introduce its more affordable Firefly brand by 2025, targeting family-oriented electric vehicles. However, regulatory changes, shifting market dynamics, and competitive pressures pose significant hurdles. In the United States, trade tensions and regulatory uncertainties have complicated NIO's entry strategy. While the company initially planned to enter the U.S. market, trade restrictions forced it to reconsider. Instead, NIO is exploring opportunities in other foreign markets. However, navigating the complex regulatory landscape and establishing a foothold in competitive markets like Europe and the United States remains formidable. Moreover, recent developments, such as Germany's decision to pull the plug on its EV subsidy program, add another layer of complexity to NIO's expansion plans. The decline in EV sales in key European markets underscores the challenges ahead. Additionally, legal challenges, like the class action lawsuit alleging misleading statements about NIO's factory construction, further highlight the risks associated with international expansion. With geopolitical uncertainties and regulatory challenges shaping NIO's expansion trajectory, investors must assess the potential impact on the company's long-term growth prospects. What do you think about NIO's prospects amidst these challenges? Share your thoughts in the comments section below. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know about NIO's plans in Europe, just click this video right here. Thank you for tuning in, and stay tuned for more exciting content in the future.